What if I told you you could erect a house in a jiffy and not worry whether it is in a prime location, whether it is sea facing, it is in a luxurious neighborhood, it has the best in class infrastructure? You get the gist. And immediately make it available for rent and start collecting the rent regularly, maybe weekly or monthly or yearly. Is that even possible? Now let's look at the real estate market. The groundwork required for us to clear all these aspects of property selection itself is cumbersome. Then after that, there is a huge upfront capital cost that is involved. It's a liquidity nightmare. Buying and selling can take months. Endless paperwork. We require clearances, approvals, registration process, maintenance costs, property tax, tenant issues, and end of it all, worst of all, the property just sits there idle, not earning the rental amount because we have not been able to gather and get the right tenant. But imagine a world where all these things disappear. Instead of a physical property, you buy equity, like say stocks or ETFs, and once you have it in a certain quantity, they create an effect of you holding a property. Such a practice is highly liquid, and we don't have to go through all the headaches that we have just discussed earlier in property selection. The entire problem now reduces to that of an underlying or a stock or an equity selection. You can very easily pledge it with the broker and raise capital without another ton of paperwork that is required to raise capital in the real estate world. And then instead of waiting for the tenant, you instantly make it available for rent by selling a call option, smartly selected strike price. Today we will be discussing one aspect of such a model, which is called as the covered call.
Subscribe to this channel and hit like as your daily commitment to bite-sized learning that compounds your financial knowledge and takes you one step closer to financial freedom. Today's discussion, that is covered call strategy, turning your stocks into virtual real estate that generates recurring income without the pains of property ownership, comes under the section of strategy, product knowledge, behavioral finance, regulatory and structural knowledge, portfolio construction, and asset allocation. As always, when we look at a strategy, we will look at it through various prisms. Today, for this discussion, we will look at it from the psychological or the mental model view, the regulatory view, the probability view, and nevertheless, we will look at the design of a flowchart so that we can wrap it up together and develop a consolidated opinion on how it is to generate a rental cash flow with assets that we might already have without the pain points of a real estate market. Let's step into the world of covered calls with a simple mental model. Imagine you're buying a house, not just any house, but a NiftyBees house. NiftyBees is an ETF that mirrors the Nifty index, and like any property, the choice of what you buy is critical. The underlying determines how naturally the model adapts to real life. We are using Nifty here just as an example, but not as a perfect choice. That is because every trader must find an underlying that they are comfortable with. Now, think like a property buyer with three mindsets. You are comfortable owning the house, but also open to selling it at the right price. You are patient. If the property value dips, you don't panic. You are willing to wait for it to appreciate again. And most importantly, you are happy collecting rent regularly. You know the rent may vary month to month, but you see it as a steady stream of income, and so you don't complain. That's the psychology behind a covered call. It's not about chasing the jackpot. It's about owning the comfort, earning the patience, and being flexible with your exit. Regulatory lens in India, when you buy NiftyBees or any approved security, you can pledge it only after T+1 days. Now let us look at the model from a probability view. Assume we have bought the 7,500 units of NiftyBees, which equals to one Nifty option, because in India, one Nifty option lot size is 75. And the way in which NiftyBees are calculated is that they are like approximately 1/100th that of the index. So 7,500 units we are purchasing. And let us say that the Nifty is at current market price 25,000. So now, based on tools like Sensible or Opta, and let us say we do our own historical data analysis, we see that the probability of Nifty gaining 1,000 points in a single month is very low in Nifty. It is probably beyond even a 4 sigma event. So with that information, let us say we sell a single call option of Nifty that expires in a month. So now the broker would give us the premium. Let us say the premium is X, then the premium would be X into 75. And this is the money that comes into our account, and we don't have to do anything. We just have to wait for the contract to expire. So the way we can view it is, let us say it is like a glass of ice that is kept. And as the day passes by, from one day after the other, the ice gradually melts. So in the end of the month, what we would notice is that the entire ice has melted, the theta has completely decayed, and the entire premium we can pocket. Now let us take the time to develop and design a flowchart view. The flowchart view design is most critical to the success of any model, because as we have already seen, the probability distribution function, the mathematics are all relevant at that point in time. And as long as the underlying keeps moving, there will be changes to the statistical implication. So in this regard, in terms of design aspects, let's consider two scenarios. It is to be encouraged for every trader to look at all possible scenarios and come up with an accurate flowchart that reflects the strategy that will be implemented in the ground. Let us look at two scenarios for the covered call rental model with the 7,500 NiftyBees bought at Nifty at strike price 25,000, and we have sold a 26,000 call option. Scenario 1, Nifty stays below 26,000. The call expires worthless, the water in the cup has fully expired, we keep the entire premium as rent. If say Nifty closes above 25,000, we can simply sell a new call for the next month, say 1,000 points above the current level, so that we can more or less maintain the probability distribution edge. However, if we are more ambitious and we want to have a higher rental, and we are willing to take a risk, even though at this point in time the probability distribution function may not be supportive of that, that is also acceptable. It all depends on the plan of the trader. So in conclusion, we saw how a covered call is a way to generate rental cash flow with assets that we might already have, such as stocks or ETFs, without the pain points that the real estate market has.